Okay. So there's some information, if you open it, there's some information that you're provided with, which is a comprehensive income statement. And they're also provided with the statement of financial position as at 31 December 2021. And then you're told here, using the information provided in question number 1, kindly answer the following. And then there are a list of different ratios that you are asked to calculate and go through. So that's what we want to do. We want to go through those list of ratios and calculate them and go through them as as a team. All right. So the first ratio that we're asked to calculate is the inventory turnover ratio. That's the first ratio that we are asked to calculate the inventory turnover ratio. So again, like I was saying last week, it's very straightforward. You just go into study guide and look for the inventory turnover ratio. So from our discussion, we know that the inventory turnover ratio, right? It's under our activity ratios. So if we check under our activity ratios, there we are. We've got inventory turnover, which is cost of goods sold divided by average inventory. That's the what? That's the ratio. Cost of goods sold divided by the what? Divided by the average inventory, right? So if we check the information that we are provided here, I'm just waiting for the document to open here. The question paper is just being slow, but I just thought maybe we shouldn't stop, right? So cost of goods sold, if you check in the question paper that I sent you, under the comprehensive income statement, you've got sales, you've got cost of sales, right? So you already have that information. It's very straightforward here. Okay. Where is my whiteboard? Okay. So cost of goods sold, the formula says what? Cost of goods sold divided by what? By the average inventory, right? That's the formula according to the what? According to the study guide. Cost of goods sold divided by average inventory, right? So if we check here in our income statement, our cost of goods sold is 4,545,000 divided by the average inventory, right? Divided by average inventory. So you might ask yourself, how do I calculate the average inventory? So for you to calculate the average inventory, you're going to need the opening inventory, plus the closing inventory divided by 2, just like you normally calculate an average, right? So what is our opening inventory? If you check in the statement of financial position, we are given here for 2020 and for 2021. So for 2020, that is our opening inventory, it's 1125, right? So average inventory is equals to 1125 plus our closing inventory, the one for 2021, divided by what? Divided by 2. And that gives us an average inventory of 6. Is that correct? 1125,123 plus 1080,123 divided by 2. That gives me 102,500, right? And therefore, our inventory turnover is going to be equals to that's the answer that we're going to end up with for our inventory turnover. Are we all on the same page on this? Are we all on the same page?
Yes.
All right.
Yes, James.
Okay, so that's our average inventory, right? The next question here says calculate the average collection period, right? So after average inventory, 2.1.2 says calculate the average collection period and you use 300.
Jay?
Yes?
You didn't divide by 2, did you? Because I'm getting a different, if you divide by 2, I'm getting 602.5.
Where are we? Average inventory there. You see where it says average
Yes.
inventory? Did
Yes,
you add
there.
the opening inventory, which is 1 million point something, plus the closing inventory, which is also 1 million point something? If you add that, you get 2 million point something. 2 million divided by 2, it gives you 1 point something million. I'm not understanding where you're getting the 6. Nalo?
Oh, all right, I'm getting it. Thank you.
You're getting it now. All right, sharp. So that's what? That's inventory turnover, right? We go to the next one. The next one wants us to calculate the average collection period. So average collection period. Right. So again, the same concept is you just go to your study guide. You just check in your what? In your study guide. Right? Average collection period. So in your study guide, average collection period is equals to accounts are receivable are divided by annual credit sales, then also divided by 360. But I was saying that this is where it gets confusing a little bit because of the way he presented his solutions. So you've got 2 options here. If you are using his formula, the formula in the study guide, you are saying here, average, is it typing? Average receivables but it's not average, so it's accounts receivables. Sorry about that. Accounts receivables divided by, you divide by the what? By the credit sales. Annual credit sales, which you also divide by 360. If you're using his formula in the study guide, which you also divide by what? By 360. That is, if you're using the formula in the study guide, right? You have to do that, right? Or alternatively, the second formula that you can use is accounts receivables divided by annual credit sales, and then close bracket here, and you multiply everything by 360, which is after you have made your division, you multiply everything by 360. So both these formulas will give you the same thing. It's just an issue of presenting your formula, how you have presented it at the end of the day. It's just that this formula is easier to do with the calculator. Then this one can be a little bit problematic when you're using a calculator, the first one from the study guide. Right. So we have this information. If we check in our balance sheet, we are given here our accounts are receivables. Accounts receivables, we are told here for 2021, it's 1,147,500, right? So ACP is equals to 1,147,500 divided by our annual credit sales. We want to know what our annual credit sales are. Let's see. So if you check on the information provided, we are told here that all purchases and sales of inventory are on credit, which means that our total revenue is on credit. So the sales figure of 9,315,000 is on credit. So our annual credit sales are 9,315,000. Right? So 9,315,000, that's our annual credit sales. right? And then divide by 360, right? Or like I said, if you use a different formula, if you use the other formula, which means you are going to say in brackets 1,147,500 divided by 9,315,000 like that, and then close bracket, and then you multiply by 360, right? Depending on the formula that you've used, but they are same formula, just that the other one is difficult to put in a calculator. That's just it. All right. So here you go. Make sure you put the brackets if you use the second formula. Make sure you put the brackets if you use the second formula. You punch it in a calculator, 1,147,500 divided by 9,315,000, multiply everything by 360. Then your answer here should be 44.35 days. Okay, that's for average collection period. Are we together?
Yes, and you are.
All right.
James, quick one. On
Yes.
the first formula, is it divide by 360 or is it times 360?
On the first formula, it's divide by 360.
Oh, okay.
Mhm.
Thank you.
That's why I don't like that formula, because sometimes it's very confusing, especially if you're punching in a calculator. You might punch it incorrectly and end up with a completely different answer. All right. So this is done. This is average collection period. We go to the next one. So the next one here, okay, finally opened. All right, sure. That's better. Okay. Yeah. I'm struggling with this thing. Okay. So the next one is a return on equity. Sorry, average payment period. The next one is the average payment period, use 365 days. So again, the same concept, you go and check what is the formula for average payment period. It's accounts payable divided by annual credit sales divided by 360, right? So again, you go back to your, okay? You go to your data. This is what average payments period, where our payments, accounts payable, there you go. So accounts payable divided by credit purchases divided by 360. Or if you use my formula, it's accounts payable divided by credit sales multiplied by 360, like this. Makes things a little easier, right? So you check the numbers. Accounts payable, we've got 10. So it's 1080 000 divided by credit purchases. You check, if you check the notes at the bottom of the notes, you're told the credit purchases are 4.5 million. So you divide by 4.5 million. and you multiply everything by 360. Right. That in a calculator. 1080,123 divided by 4.5 million. And then 360. That gives us 86 days. 86.4 days. So again, same concept. If you use the formula in the study guide, you're just saying 1080,123, divide that by 4.5 million, 123, and also divide that by 360 if you're using the formula in the study guide. You still arrive at the same solution at the end of the day. It's just that punching this in a calculator like this, you might not know how to do it. To just punch everything together, divided by in the calculator. All right. So again, this will give you 86.4 days. Right. So that's what? That's accounts payment, average payment period, right, for 2.1.3. Then if you go to 2.1.4, return on equity. When 1.4 return on equity, again, you check in your study guide, what is the formula for return on equity? Please make sure your mic is muted if you're not speaking to us directly. Okay. So return on equity, that's the formula there. Earnings after interest and tax, which is the net profit, divided by the shareholders' equity. That's a formula for return on equity multiplied by 100, right? So we check here, earnings after interest and tax. Earnings after interest and tax, which is this one here, 1980. That's our earnings after interest and tax. And then what is our shareholders' equity? Our equity here is this one, right? So earnings after interest and tax divided by shareholders' equity multiplied by 100. That's the formula according to the study guide. And we know our earnings after interest and tax is 1980,000 divided by shareholders' equity, which is 702,000, multiply everything by 100. And then you get a percentage answer there. 1980,123 divided by 702,023, multiply everything by 100. And then you get 28%. 28.21%. So you can see, just like I was saying last week, these you should totalize, because these things are very, very straightforward, especially when they're doing ratios. They're very, very straightforward. You already have the formula in the study guide. You are just following the formula and you're punching in your calculator and you're getting the answers. So I don't expect you guys to struggle with ratios. That is just a question where you're supposed to get everything from that from that particular, other than maybe the theory part, that's where maybe you might lose 1 or 2 marks. But the calculations for the ratios, you should be able to totalize these ones, because they're very, very straightforward. There's no hidden things that are funny there. All right. Next one, dividend per share. Right. So again, you go to your study guide, you check where is the dividend per share ratio. Dividend per share, ordinary dividends over number of ordinary shares. Ordinary dividends over number of ordinary shares. So you just have to check what is the number of ordinary shares. You are told here, number of ordinary shares, 750,000. What is the dividend? Total dividends for the year, 810,000. So it's there. There is really nothing to it, right? So ordinary dividend over number of shares. That's basically it, right? So ordinary dividend, you know, it's 810. Number of ordinary shares, 750. So dividend per share, 810,123 divided by 750,123, and you get 1,08 rands per share. That's your dividend per share there. If you want to put it in cents, it's 108 cents per share. Or if you're putting it in rands, it's 1,08 rands per what? Per share. So you're done with dividend per share. You go to the next one, acid test ratio, right? So again, you just go to your study guide, check formula for acid test ratio. There you go. Current assets minus inventory over current liabilities. Current assets minus inventory over current liabilities. So you ask yourself, what are your current assets? You've got the answer there. Current assets, right? What are your current liabilities? You've got the answer there. Current liabilities, what is your inventory? You've got your answer there, inventory. So acid test ratio, it's current assets minus inventory over current liabilities. So current assets, 2430,123 minus inventory, 1080,123, all of that divided by current liabilities, which is 2025,123. And then what do you get? 2430,123 minus 1080,123 divided by 2025,123, and then you get 0.67 as your current ratio. So this is less than 1. So if you are to comment, you will say that this company is in trouble because they are not able to pay. And remember what I said, current ratio, usually we express it as a ratio. So it's 0.67 as to 1. That's the ratio for the current ratio. But even if you write 0.67 just like that, you still got the answer correctly because that's what the ratio is, 0.67, right? So current ratio is done. Go to the next one. Next one is the debt to equity ratio, right? Again, you go to your study guide, you check debt to equity ratio, long-term debt over shareholders' equity. That's the ratio, long-term debt over shareholders' equity, right? So you come here and you check long-term debt, you've got here, that's your long-term debt over shareholders' equity, you've got here. So your ratio becomes 123 divided by 123. 123 divided by 7020, 123. So we get 25.6% debt to equity ratio of 25.6%. Or if you want to express it as a ratio, is 0.25 as to 1. If you want to express it as a ratio, 0.25 as to what? As to 1, or 25%, right? As a what? If you multiply by 100. If you want to put to percentage, remember, percentage, you're just multiplying by 100 if you're putting to a percentage. But if you express it as a ratio, 0.25 is to 1. But if you express it as a percentage, if you just multiply by 100, it becomes 25%, right? So that's your debt to equity ratio. So you can check this one, you can multiply by 100 because that's what he wants, for you to multiply by 100. All right, next one. Comment briefly on the following ratios. comparative figures are provided in brackets. So you can see what I was saying. So this is 2, 4, 6, 8, 10, 12, 14. So all of these 14 marks, you just had to calculate. There was no commenting, there was no note, there was just calculating. So you should be able to get 14 out of 14 on this one, right? Then this one where you comment, this is where maybe you can lose 1 or 2 marks where you're commenting. But the one for the calculations, you should just totalize because you have the ratios already. So you just put your figures, plug in your figures and calculate. It's very, very straightforward. I don't expect you guys to struggle with this part. All right, so let's comment on these ratios. So we are told here, briefly comment on the meaningfulness of these ratios below. Current ratio in 2021 is 1,2:1. In 2020, it's 1,07:1. So you can see here, remember there are 2 types of comments. There is a comment number 1, which is trend analysis, and comment number 2, which is comparative analysis, right? So according to trend analysis, we can see that the ratio from 2020 to 2022, it improved. It what? It improved. That's according to what? According to trend analysis. So we can conclude that this company, right, its liquidity position is improving, right, over the years. This company's liquidity position, because current ratio represents liquidity. This company's liquidity position is improving, right? However, because there's 2 marks, we can also highlight that the standard current ratio for most industries is 2:1. That's the standard current ratio. So this company has not yet achieved 2:1 because their ratio is 1,20:1. So they've not yet achieved 2:1. Therefore, we can conclude that they still have low liquidity, right? So although it is improving, they still have low liquidity. Why? Because they've not yet reached the standard, which is 2:1. Which is 2:1. So that's our comment on the what? On the current ratio. Right. We go to the next one. Earnings per share. We can see here earnings per share in 2020 was 280 cents per share. Earnings per share in 2021 was 264. So there was a decline in earnings per share. So we can conclude here, number 1, there was a decline in the trend for what? For earnings per share, for EPS. There was a decline in the trend for EPS. That's our first comment. Then our second comment, which is comparative. Unfortunately, we are not given here any figure to compare with any other company other than the company itself. So we can then just conclude here that we need to compare the performance of this company with other companies in the industry. Right? We need to compare the performance of this company with other companies in the industry, as earnings per share represent the earnings of the company over time. Right? So if this company's earnings per share is lower than the industry average, then we can conclude that this company is not performing up to the industry. But if this company's earnings per share is above the industry average, then we can conclude that this company is performing very well. But because we don't have this, we can maybe just put only one comment on what? On trend analysis, where we can say that there is a decline in earnings per share, which reflects that the profitability of the company is in decline, right? Which means that the shareholders might not look favorably upon this company. This can actually lead to a decline in the market price per share because the earnings per share is declining for this company. Go to the next one. Net profit margin, 25% to 21%. So again, there is a decline in the net profit margin, NPM, right? So we can highlight under our trend analysis that there's a decline in the NPM. Then under our comparative analysis, we are not given here anything to compare against, but we can maybe talk about how can this be improved by the company. The company might reduce its costs, overall costs of production, right? And the company might need to increase maybe its sales revenue, might need to find ways of increasing its sales revenue in order to improve the what? The net profit margin. So they can either increase the sales revenue or they can reduce the sales. But a decline in the net profit margin means a decline in the profitability of the company. Just by that, you get your what? You get your full marks here. You are going to get your full marks there. And then you are done for this paper. You get your 20 out of 20 for the question on the on the ratios. So that's basically it. That's how you work out ratios within an exam situation. Are there any questions on the issues of ratio analysis? Are there any questions on the topics that we've done on ratios, unit 3
James,
and unit 6? Yes.
2.1.6 acid test ratio. What is it for? I thought you were saying acid test ratio. What is it?
Acid test ratio is a liquidity ratio. It's like the current ratio. It's a liquidity ratio. It tests the liquidity, the ability of a company to pay its short-term liabilities. Because a company, when it is operating, right, they borrow from their suppliers. So you go, let's say you're in Credible Connection, right? You borrow laptops from Apple, from Samsung, from HP, and then you sell them, and then you come back and you pay, right? Your creditors or your suppliers. So your ability to pay, if HP or Samsung or Apple was to say, can we get our money right now? Are you able to pay them? That's what the acid test ratio is trying to check, right? It's just a liquidity ratio assessing the ability of the company to pay its short-term creditors, right? So there are two ratios. There's the current ratio, and then there's the acid test ratio. The current ratio, in its calculations, it includes the inventory, right? It's saying that using the cash, physical cash that you have, using the debtors that owe you money, and using the stock that you have, that is, if you are able to sell the stock and get money, how fast can you pay your liabilities? That's the current ratio. Then the acid test ratio assumes that you are not able to sell your stock. So they're asking you, only using the cash that you have, plus the people that owe you money, are you able to pay your short-term liabilities? That is why when we're looking at the acid test ratio, we want it to be 1:1. But when we're looking at the current ratio, we want it to be 2:1, because we don't know if we can sell the inventory or not. I hope you answered.
Yes, thank you.
All right, sure. Okay, so that's what I wanted us to do today, just some calculations. So just an update. Unit number 1, we've covered this. Unit number 2, we've covered this. Unit number 3, we've covered. Unit number 4, we did this one. And then unit number 6, we've covered this. If you did not attend any of these classes, make sure that you get the recording and watch the recording. So when we meet next week, we are going to be looking at unit number 5, which is financing and cost of capital. That's what we'll be doing when we meet next week, unit number 5. I'm sure you can already see that we are almost at the end, which means that we are only left with 2 weeks for us to complete the study guide. So we'll meet for unit number 5 next week, and then the following week we'll do the last unit. And then from then, we'll just be doing revision, right? So unit 5 next week on the 21st, and then unit 7 on the 28th. And then we know that for this May, we are done with the study guide. And then in June, we'll just be doing revision papers. Okay. Anything else before we close for tonight?
James?
Yes.
I just want to find out, on our first comment, you mentioned that we compared with 2:1. That 2:1, who determines it? And is it a value that is known out there?
Yes, it's a value that is known out there. For the current ratio, it's 2:1. It's a value that is just known. Any person doing accounting uses that 2:1. And then for the quick ratio, it's 1:1. It's a value. These are just values that are known in accounting, that if you're calculating current ratio, your aim is to get 2:1. If you're calculating quick ratio, your aim is to get 1:1. Right? So this is for these 2 ratios. All the other ratios, you will actually need your lecturer to tell you that what is the standard. For example, if you're calculating data's collection, right? If you're calculating data's collection period, your lecturer will usually tell you that the company has got credit terms of 30 days. That's what he usually says. So if he tells you credit terms of 30 days and you calculate and you get 45 days, which means you've got a problem. If you calculate and you get 20 days, which means you're okay, because you're below the what? The credit terms of the company. But if you calculate and it's above, then you've got a problem. But this one, you are told. The data's collection, you will tell you the creditors collection, he will tell you. If he does not tell you, then you can either make an assumption or you can generalize. You can generalize your comment that you're making. You don't need to be too specific if he has not told you any extra information. But usually, trend analysis, that one is mandatory because he usually provides you information for trend analysis. He will give you a ratio for the last year and will give you a ratio for this year. So you can compare the two and highlight whether it improved or it declined. But in terms of the comparative analysis, if he does not provide, then you can ignore the comparative analysis. You can either generalize or ignore it, or maybe you can focus on talking about how to improve the ratio, right? You can talk about how to improve, what actions can be done by management to improve the ratio of that specific company. Okay. Any other questions?
James,
Yes.
last week, this week, you have not sent any recordings.
Oh, is that so? Okay.
Yes.
All right, it's fine. I will download it and send it through. I thought I'd send it to business finance. Let's see here. Recording for
Sorry,
business
James, and
finance.
for economics as well.
All right.
Economics and marketing, all the subjects, all the modules.
Yes,
Okay. All right.
yes,
It's
nothing
fine.
at all.
Okay, it's fine. I'll download them and send them through after the class.
Thank you.
Sure. All right. Thank you guys for coming in. We shall see each other. I think we've got a class tomorrow for economics. We'll see each other tomorrow.